Are world markets closing? This question might seem startling, but given the recent events, it's worth asking. There's been a notable sell-off in major sovereign bond markets, a trend that's anticipated to continue for at least another 3 months, according to a recent Reuters poll. The European Central Bank is predicted to tolerate a spread of 250 to 275 basis points between German bonds and Italian 10-year debt. This is a significant increase from the current spread of around 200 basis points. In addition, strategists are forecasting a rise in German 10-year bond yields to 1.75% in a year, while the yield on the 10-year U.S. Treasury note is expected to rise to 3.2%. Interestingly, the yield spread between 2- and 10-year bonds is expected to drop to minus 20 basis points in a year, hitting a low not seen in over a decade. In stark contrast, Japanese government bond yield forecasts show little change, indicating that the Bank of Japan continues to deviate from the policies of other central banks. Nevertheless, almost half of the polled strategists expect the 10-year JGB yield to surpass the Bank of Japan's 25 basis point yield cap in a year. The global sovereign bond market's future seems to be in a state of flux, with the European and American markets anticipated to experience some turbulence. A critical player in the global market, the U.S. Federal Reserve, has made some aggressive moves lately. The expectations have dramatically shifted, with the probability of a hefty 75 basis points rate hike now sitting at a staggering 89%. This significant shift has triggered a sharp sell-off in global markets. As a result, the potential impact on equity valuations, especially in the technology sector, has become a point of concern. There are fears that such an aggressive rate increase could jeopardize the recovery process post-COVID-19. This fear is not without merit, considering the U.S. S&P 500 index has entered a bear market, having fallen more than 20% from its recent high. In addition to this, yields on U.S. 2-year and 10-year Treasury notes have spiked to their highest levels in years. This situation is often interpreted as a sign of an impending recession, adding another layer of uncertainty to the mix. The Federal Reserve's aggressive moves have undoubtedly sent ripples across the global market, raising questions about the future. While the US and Europe grapple with their financial challenges, let's turn our gaze towards the East. Asian equities have recently been in retreat, with most markets falling despite record highs elsewhere. The MSCI's broadest index of Asia-Pacific shares outside Japan fell by just over 0.5%. Concerns about new regulatory crackdowns in China and the impact of the Delta variant have certainly weighed on investor sentiment. In Japan, the Nikkei dropped by 0.6%, and in Korea, the Kopsi fell by 1.45%. Hong Kong's market also felt the pinch with a drop of almost 0.5%, and Chinese blue chips fell by 0.1%. Despite these drops, there was a glimmer of hope as Australia's ASX 200 rose by 0.5% to a new record high, driven by healthcare and technology companies. The future of global markets is uncertain, with Asian equities also experiencing a retreat.